The way we approach investment in Australian equities is we have a team of analysts / portfolio managers that look across all the stocks in the Australian market, and we have a very consistent approach to valuing those. So in simple terms, they are the building blocks of what we can use to build any portfolio structure. But understanding those building blocks and valuing the companies is the raw material for every product that we put together. And that is, our DNA is about what do we believe in valuing those companies and what matters to us in coming up with those valuations. Because in our view, valuing a company is our core job. Our job is not just to opine on whether it's good, bad or indifferent. Our job is to work out what we think it's worth. And that's what we do. And then once we've done those building blocks, that raw material and the risks around it, the amount of financial leverage, all of those sorts of factors are woven into how risky we think those valuations are, how diversified a portfolio we want, and what we think suits the end investor. But our belief in what we want to buy as investors really is anchored in, of course, we want to buy decent quality companies, and very importantly, we want to buy ones that we think will last. We look for business models that we think are sustainable, because when we're valuing a company, if a company is not going to generate sustainable earnings, it's not worth very much. So in all times, when you buy an equity, you're buying something that you think is going to have reasonable duration. You're buying a stream of cash flows into the future, and next year's earnings are generally only a fairly small part of what that company's worth. That is the fundamental reason why we put a lot of emphasis on how long we think a company can last, and why its business model works, why it's going to have advantages, and why we believe it can earn a certain amount of money in the future. Then we spend a lot of time thinking about, well, what do that stream of cash flows look like? What does the picture of the cash flows look like in the future? And then we go into the rigmarole of discount rates and so on, and what do we think the business is worth. It's only when we've got that anchor of what we think a business is worth that we think we have the raw materials to start building portfolios. The heart of ESG in our eyes is really about sustainability. It's why is something going to last? And it's crazy to think that this is something that we should have just started thinking about in the last few years. Sustainability's been important forever. And ESG as a factor is just saying, is this company doing something that we think is compromising the sustainability of its cash flows or enhancing the sustainability of its cash flows? And whether it's climate change or environmental issues broadly, biodiversity, all of those things, they're just parts of that picture. Is this company behaving in a sustainable manner, and is the way that it's generating its cash flows causing us any concerns in terms of, if it's a carbon price, then in our eyes we'd say, if we need a carbon price that's going to affect the company's cash flows in the future, we need to put it in the valuation. So the heart of how we treat ESG is anything that is a sustainability issue, we try and get into the cash flow forecasts of a company so that it's totally encapsulated in what we believe that business is worth. The main funds that I'm involved with, along with Andrew Fleming, who's Deputy Head of Equities and Portfolio Manager, and Justin Halliwell, who's our Head of Research, we sort of spend most of our time on the primary long-only funds, of which the Australian Equity Fund is one and the Equity Opportunities Fund is another. Both of these are long-only funds that have a pretty diverse approach to investment. We always want them to be economically diverse portfolios that suit generally most investors with a long-term time frame who aren't that worried about volatility, but are generally looking for a sensible portfolio of reasonably valued investments that are going to give them a reasonable return, both capital and income, in the medium term. The main differences between the two is that Equity Opportunities is a totally benchmark unaware fund, So actually it's got a 5% cap on any company, which in an environment at the moment where you've got something like BHP at 11.5% of the benchmark means you've got quite a different structure to the benchmark. But in that absolute return focus, it is also going down into the small and micro cap end of the market, such that the universe of companies that it looks at is a bit broader than the mainstream equity fund. The Australian Equity Fund, again, is a pretty broad portfolio. It's investing in the ASX 200, ASX 300, but it doesn't go right down into the microcap companies. But again, it's giving you a pretty diverse, long-only exposure. And again, that focus that we have on sustainability and sensible valuation metrics means that it's always, both products are going to suit investors who believe that, yes, the quality of business is important, but the price at which you pay for them is important as well. We are not believers that a good company at a crazy price is a good investment. And that philosophy flows through all of those products. My rationale in investment and how do I invest my own money, again, it goes back to saying I want a common sense approach to investing. We don't believe we're the smartest people in the universe. We don't believe that we've got this massive differentiation that sees us being way smarter than everyone else. What we do is do a lot of work to understand companies at least as well as our peers, focus on that medium term and focus a lot on sustainability. So you want to be most people want to be able to sleep at night with their investments, where the way we invest our own money and the way we invest clients' money should be identical. And they are, and we all have a lot of our own money invested in the funds. And how do we behave with those investments? It is just that common sense approach of saying, don't get carried away when others are getting carried away. Don't panic when others are panicking. And generally we're going to be a bit contrarian because that's in our DNA. When other people are panicking, we're getting more enthusiastic. When other people are getting euphoric, we're generally getting more cautious. That's the path of investment over time. Volatility doesn't scare us. We don't think you should be worried about matching the benchmark every day. But again, it's about sensible economic diversity. We are not seeking to be heroes. We're seeking to be a good, sensible mainstream investment for most people out there.